Hello, everybody. My name is Stefan Friedrichowski, and I welcome you to the next webinar within our webinar series, Developing Superb Trading Strategies. Yeah, it's always good to have you here. It's a pleasure for me that you are always present here in that webinar. And by the way, thanks to Argus-FX, the broker of our choice, who make that webinar series possible. Yeah, as always, oh no, first I have to mention the date, just for the records, that we can have those numbers in the records as well. Yeah, we have 11 o'clock as always, and today is the 15th of December 2016. The topics for today are quite easy because we have done already a lot of work concerning pair trading and a new kind of strategy which came out, so to say, out of that idea, which is quite promising as well. And I mentioned it already last week that this is more a so-called mean reversion strategy, and I will go into that topic especially today. As always, you find the recordings in my YouTube channel, and you might see that in the GoToWebinar channel or panel that I have posted a PDF document with my slides. So whenever you have problems with that complicated channel name of my YouTube or with my email address friedrichowski@argusfx.com, you will find those in the documents as well. You can download those documents by your own simply by pressing the appropriate document. So that's quite easy, and I think that will help a little bit more. And by the way, you can have those slides for your own. So the topics go from questions. That is the first one as always, and I will make a remark about yesterday as well, because yesterday we have had the Fed decision in the United States, and yeah, there are news, and that's good for us that there are news, and let's see how the market already reacts on that first increase of interest rates in the United States. Then I will recap a little bit on what we have done about pair trading, and the one which not really has a name already, but I give the username already now. That is a mean reversion strategy. And I will show you in detail how we can go on with that kind of strategy forward. Because what has been missing in the basic idea of that strategy was definitely the stop loss of a trade, and now everything is ready within the Excel sheet to incorporate a stop loss as well. And let's see how, and let's call it the response of that strategy is. So how the equity looks like and how we can go forward with that new concept as well. So let me start with the Fed decision. Just that one has an idea of what and how the market has reacted yesterday. You can see here simply 6 charts, and those 6 charts are H1 charts, so 1 hour, one candle is 1 hour, and it's not quite difficult to see at what point in time the decision was made yesterday. So it is exactly where my cursor is right now. Let me have the cross here within my cursor so that we can see it exactly. So this is the line, or this is 8 o'clock p.m. German time yesterday, and that was the Fed decision. And what is, at least for me, quite astonishing is that not the overall market has reacted. So what we can see here, just by one short view, is that most of the currency pairs have not changed their behavior. You might say, okay, because all the forex pairs have the euro in the first name, so the euro, Australian dollar, euro, Switzerland francs, yeah, but normally those will react as well. What we can see here is clearly, of course, we have a reaction in the euro US dollar. US dollar is getting stronger, so the price goes to the south, but we see an additional reaction in the euro Japanese yen, and this goes into the upward direction. By the way, if you see something like that, it's always then a good idea to trade the pair US dollar against Japanese yen, because then you will have the biggest change in that pair. But I think you remember we have had that kind of topic when we talk about lead lag strategies, because that was a basic assumption of that strategy. All the other forex pairs do not react. Of course, if we look for something like US dollar against Canadian dollar, we will see a reaction as well. And that you can already get out of that screen as well, because there's no reaction in euro Canadian dollar, and we have a reaction in euro US dollar. Then of course there's a reaction in US dollar against the Canadian dollar as well. But for me personally, it's astonishing that only US dollar has reacted. Okay, that's not a surprise. But we have a reaction in the Japanese yen as well, but nothing else. So let's see how that goes further. I don't want to go through thousands of charts now. Interesting question is, of course, how does the S&P 500 and, for example, the DAX have react on the yesterday's decision? But the answer is quite easy, more or less nothing. So no big reaction in the indices. So, yeah, the only comment one can do is everything was already incorporated into the prices, and no surprise has happened yesterday. So, but that is a comment you will find in NTV or wherever. It's quite easy to make those kind of comments, because you always do them in a way that they fit to what has been seen in the market, and it's quite easy to find a comment which fits to market movement always. Anyhow, so that's the first move. I stick to my statement. It's good. It's very good if we have now changes in interest rates at all. So because that will create long-term movements in the currency pairs as well. So hopefully we will have the next steps wherever on the world, maybe in Australia, maybe in the United Kingdom, and maybe in the EU. But let's see. It's good, because then we will have much more possibilities for trading if we have changes in the overall interest rates. Back to the slides. I promised that I want to go to the question and answers, and there was a quite interesting question, and I would like to share this with you as well. Oh, I have not opened it right now. Let me check this. Okay, and then now I will get that here. So it's a little bit to read here. But I will comment, so you can either read completely the text here or you just listen my comments. And the main topic here is the question how to use professionally the tick data. And the author here mentioned that it is even quite difficult first to get appropriate tick data and then to have those tick data really reliable. So that's in principle something which is quite difficult, because especially when we talk about Forex, yeah, there is no real market, so to say. It's different to stocks or to future trading, because all the trades in the Forex pairs are done what is called over the counter. So there is no central authority collecting all those trading activities. So we never know what is around and how much has been traded at what price level. And that is something we would normally like to have, but and this is that would mean that we would have really, for example, even volume per tick. That would be really nice, and but there is no possibility. What you can do in principle, we have all the Forex pairs on the future market as well, and there you can in principle get those data, but it's only part of the overall market, and future markets and spot markets, there's always a difference between them, but finally even the future markets would then only be an indicator for the spot market. And I repeat myself, and finally you don't know anything for sure. But the main question here is more related to, not to the question of how much volume per tick has been traded. It is more related to testing strategies, and especially if you try to develop strategies with quite small stop loss values, and let's say small stop loss values and maybe small take profit values as well. Then you automatically have the problem of whatever data you take. So if you take data like I do, for example, candle data M5, candle data H1, then you have another problem, and then the problem is that you don't know what happens first. So I switch now a little bit here to my answer to all those questions, and you can read that if you want as well. So the principal problem is that if you go for candle data, that you finally don't know whether the stop loss has been reached first and then the take profit, or maybe first the take profit and then the stop loss. So that is something I cannot resolve, or there's no, with candle data, there is no possible answer to that. And therefore, the author here stated, hey, I want to go for tick data, because then, of course, you can answer that question. And you always know what has been reached first. The problem now is the reliability of the tick data itself. And the only thing you can do here is you can try to get data from different brokers. And what I personally would do then is I would look for the broker with the a lot of tick data. So the more you have, the better. And one possibility, by the way, would be Dukascopy. Dukascopy is offering tick data, and there are other tools to get those tick data downloaded automatically, because on the website of Dukascopy you can only download within one download you can only get data for 1 day, but there are tools to get that being done automatically. So that might be a source, but still the question is of reliability, and finally you want to develop a strategy, and then you want to run the same strategy, and then you are you rely on the new data as well. So anyhow, that's a way to go for tick data. What I do personally, I still stick to my candlestick data, and I have a simple rule. And the simple rule when I do developing any trading strategy, my simple rule is that my basic assumption is stop loss first. So if I don't know which one has been reached first, stop loss or take profit, I decide for stop loss. What finally means is that I may make my strategies worse, or not may, I definitely make those strategy worse, but I don't know to what extent. So, but I don't want to blend myself. If I would reverse that common rule to take profit first, then definitely I would blend myself with a strategy, especially if I have small stop loss values. Okay, so that's how I do it. So finally, I don't have a real good answer to everything, but I made here a general comment. I cannot prove that comment, of course not, but it's more related to, let's call it my mathematically feeling. And that is a statement that I personally do not believe that for a private person it's really possible to have strategies running with very tight stop losses. And the reason is not how to do it or how to implement an expert advisor doing that kind of strategy. No, that's not the issue. But normally, small stop losses go with small take profits. And finally, what we have to do always is we have to earn the costs of trading, either commission or spread values or higher spread values. So since we have to earn that fixed amount, spread and commission, and we need a move into the right direction, the smaller that stop loss is, the harder it will be to at least earn spreads and commission within the trade. So if you think about strategies with extremely tight stop losses, then you would need extremely low trading costs. That is possible, yes, but not normally within CFD trading at standard brokers. So you would need same trading conditions as the so-called institutionals. So you would need the lowest spreads you can get, like we have them, for example, at Argos-FX, but you would need commissions in the order of about $2 per lot. And that is something you cannot get within the CFD trading. But for example, if you go for future trading on Forex pairs, then you can get that kind of conditions, but that's a different world. For example, you will not anymore be able to trade anything below one lot. So you can trade one lot and upwards, but even that is possible, and it needs a little bit more money. And then you will finally get commissions which are much lower. And then it might be possible to have those strategies with extremely tight stop loss and take profits. So it's a little bit the relationship between stop loss distance, so to say, and cost of trading. So that have to be balanced, and then those kind of strategies might work as well. Okay, it's a long introduction here, but I think it's worth to do. I like those kind of questions, and I hope that you like my answers, at least that you get a little bit information out of that as well. Okay, let's go here now into our topics for today. And I want to start with a short recap on what we have done already. So what we have done within the last couple of weeks, we have done first pair trading, and then we turned that kind of strategy into something I last week called trading the excess, or today I will call it from time to time overacting. I don't know a good wording in English here for that, whether it's called excess or overacting or exaggeration, whatever. I know that you know what I mean, and I think that's the best. So we have developed a pair trading strategy, and the concept behind was simply that we looked for a deviation of the ratio, of the quotient of the two of the pair, of the two underlyings we have in mind, and that we build the deviation from that ratio to an EMA on that ratio. And whenever we saw something like overacting or excess on that quotient, then that was a trigger to open trades, a long and a short trade, always in as a pair on the two underlyings. And what we realized was that this concept works extremely well on the pair of Brent and WTI, so 2 times oil. That was quite good, and that will be a strategy we go live for sure. And what we realized as well, that if we took the same concept and put it on S&P 500 and Dow Jones as another pair, then it did not work. More or less. So at least with our 2 parameters we still have, or the 2 degrees of freedom, it was not possible to get something profitable. It was not that unprofitable, but anyhow. So it did not really work. Still, we used that same kind of concept, and originally the idea was quite easy. I want to adapt that concept to a single underlying. So within the Excel sheet, I have done this simply by replacing one underlying by a lot of ones. So the price was set to 1, and I could use simply the concept of the Excel sheet, and we have been able to get a new strategy, and that strategy on a single underlying, in this case S&P 500, worked well as well, which is quite good. And now, yeah, there are some open topics on that, because if we now trade a single underlying, of course, we can easily introduce a stop loss for those trades. And so that is one thing to be done. And of course, I changed now the name because still to talk about a pair trading, if there's one pair, a constant one, that is not an appropriate name. So it's a mean reversion strategy. So the 2 pictures I would like to remember everybody was the one here that we have a good strategy for Brent WTI, simply as being traded as a pair, and that worked quite well. We translated everything in dollars and so on, and still we have something which is quite good. So that's the equity line without any huge work of optimization. So the good thing is we can use parameters a little bit as we want, and still the strategy remains profitable, which tells us that the strategy is quite robust, and that we don't have problems with different parameters. So we adapted that concept to the S&P 500 itself. So you see here still those ones, which means, hey, there's no real pair. And we realize that we can get a profitable strategy already. But what we realized as well is that we have from time to time very high floating minuses, and yeah, and therefore, and if we trade now only one underlying, of course we can go for the stop losses as well. So I have done this kind of work, and I will share with you in a minute. But let me first introduce you that kind of concept a little bit more general. And that kind of concept we are trading now, we would simply look a little bit different. No, that's already the Excel sheet. Back to my slides here. And that is that if we use that kind of strategy, and you will see in the Excel sheet later that of course now I took out the constant ones, so it's not anymore a pair trading strategy. It's a mean reversion strategy. And there are some basic assumptions in mean reversion strategies. And more or less there are only two. And the first one is that one believes, and the strategy is more or less based on that there is a fair value of an underlying. I don't define what that means, but there is at least that kind of assumption. And by the way, I cannot define the real fair value of an underlying. It would be nice if I could, but I don't have a real definition for that fair value. But we assume there is one. There is a fair value. Let's take that as an assumption and nothing else. And the strategy is then always running in the same way. We look for, and I now call it simply, huge deviations of the price compared to that fair value. So whenever we have a bigger distance, a deviation, you can think in percent or absolute or whatever, if there's a bigger deviation between the actual price and that fair value, then this is a signal for a trade, and the underlying idea is that the price would tend to come back to that fair price. So it should go back, let's say go down if the deviation was in the upward direction, then it should move downwards again to that fair price. The fair price in the meantime might change as well, but the assumption is the actual price will go back to the fair price, so that this deviation tends to go to zero once again, whatever happens in the meantime. And now, looking to different kind of mean reversion strategies, there are a lot of ways to come to something which is called the fair value. And it's only still an assumption. There's no proof that this is a real fair value, but it's something we can use for any trading strategy based on that concept. And one possibility, and you know that this is at least right now our first choice, that we take an EMA, or we might take an SMA as well, on our underlying of interest, and we simply declare that value being the fair value. So it's no proof, but it's an assumption, and we will look whether this is good or not. So we cannot prove whether this is a real fair value, but at least we can develop a strategy on that. Something quite similar, it's only from a mathematical perspective, it's different. in most cases, it will have similar results that I know, but how to do it is completely different. You can think about regression lines in your price. Regression lines, what I mean here is simply something we do in Excel already thousands of times, that we put a straight line to a certain amount of price history. So let's think in bars. If we look back, for example, 100 bars or candles, then we can draw a line, a fitting line, a straight line into that price as well. And now we can state that this linear straight line, and where this one ends in the present, that this is the fair value. So that is a good concept as well. So we would fit a regression line into the price with some assumption of how many bars we want to fit. Maybe 10, maybe 100, maybe 1000, whatever. So that is a good concept as well. And I have already strategies which look exactly for something like that. And that is a mean reversion strategy as well. You might also think about other values for what you call the fair value. For example, what you can take is you can take values from higher time frames. What I mean here is, for example, let's say we go on a daily basis and we simply declare the weekend value being the fair value for the next week. Just an assumption. So something like that can be done as well. Or we can think about so-called pivot points. There are a lot of definitions for that as well. And that might give you a fair value as well. So you see already there are several possibilities, and if you get creative, you will find tens and 100s of them by your own. Still, there's a question, which one is the fair value? But the answer here is quite simple. We don't really want to know what is the right definition of a fair value. What we want to have is a strategy which works. So the better the strategy, the more I tend to say, yes, this is the fair value. So, but since we are not doing everything here theoretically, we want finally to have a running trading strategy. It's whatever we take, and if it works, then it's good. And once again, the common rule here is that any overacting, any excess will be corrected, and this will be our trading direction. Let's look what I have done in the Excel sheet. And first of all, I want to show you that what I have done is based on something we did weeks or even months ago. So we have had already a strategy, completely different story now, but I only want to tell you that having one already good Excel sheet which is able to simulate trading activities based on candlestick data, if you have already one Excel sheet which works, then you are extremely fast in adapting a new strategy within that Excel sheet. At that point in time, that was a DEX strategy based on a daily price, and it was a so-called EMA cross strategy. And we developed that kind of Excel sheet which was able to do the simulation with whatever we put as EMA values, stop loss values, take profit values, and so on. And what I did now is I simply took this Excel sheet and changed a little bit about the conditions for long, the conditions for short, and when and how a trade should end. And I came up with what I now call the mean reversion strategy. And so it was not that a big task to do that Excel sheet. So let's go to the result. And the result now is my S&P 500 mean reversion strategy. And let me guide you before we go here to the equity line. I know that always this is maybe the most interesting part, but I would a little bit guide you through how the strategy is done and what kind of parameters can be changed now. So let's look a little bit here into the details, because by the way, if you finally want to have those Excel sheets, you can have them. And then if I talk a little bit about those Excel sheets, it might be a little bit easier for you to do the appropriate changes by your own. So we start with S&P 500 data. So I put them here, dates, open, high, low, close, as a standard. And then, of course, we calculate an EMA on that S&P 500 data, and we can still change the EMA period by going for other numbers. Right now it's a 5. You can change to whatever number you want. Yeah. Then, as mentioned already, I want to have a strategy which is based on the deviation to an EMA, since I called that EMA now the fair value. So therefore, what I did here is I calculated the percentage distance of the actual price, the closing price of a candle, compared to the EMA on that candle. I have to make a remark here already, or a comment, because, and I will change it later, that is not exactly in line what we did last week. Because last week we did our deviations not percentage-wise. Last week we did all the deviations in absolute numbers. In absolute numbers means without that term divided by G14. Today I will do it percentage-wise, and later I will change it back to an absolute value as well. I still believe that the percentage consideration is the right one, because the S&P 500 has quite different values within the time frame. They are not that big, the changes. It's a little bit between 1,000 and 2,000. So it's not like DAX values between 1,000 and 10,000. It's a factor of 10. It's here, it's only a factor of 2. But still we will see that there is an impact of that as well. So I built that deviation. And now it's the question, what is an entry signal? And an entry signal we defined as being an overacting. So what we look here is, we look whether the actual deviation is exceeding a certain limit. And if you look to the Excel details here, you can see that I compare the actual deviation with something which is simply the product of this multiplier and the number which is written here. And this is once again simply the standard deviation of all deviations in the price history. So let me make one remark on that as well. This I have done only because the actual numbers of deviations, they depend strongly on the EMA value. If you have low EMA periods, then all the deviations are much smaller than if you have high values of the EMA period. Then in principle there might be even quite huge deviations between the actual price and the EMA. So the smaller the EMA period, the smaller the deviations. That is the nature of EMA. And in order to incorporate that kind of behavior, I use the standard deviation as a standard and then a multiplier on that. So back to the entry signal. So whenever we have something like exceeding a certain limit in whatever direction, to the minus or to the plus, then this will trigger a new trade. And or this will trigger a signal, better to say. And then we translate those kind of triggers either in a long signal or in a short signal. So let's go directly here to those numbers, and because now you get a feeling how the strategy works. So if the deviation of the actual price compared to the EMA on that price goes strongly to the south, so to the minus here, like here, then we open a long trade because we want to have the actual price going back to the fair value, which is meant to be the EMA value. So therefore, you can see here we have signals for long directly at the very beginning. And now what this Excel sheet is doing is it operates a little bit like, let's say, an MT4. So it simulates how the trade goes further. Of course, we don't, even here we have two candles, we have two entry signals. We would only trade the first one, and then we say, hey, there's a trade running. And we would not open a second trade. In principle, you can do, but this Excel sheet is not built like that. So it's going to simulate the results of the first signal, and therefore, for example, we will store the entry price and so on and so on. And then finally, we can calculate all our trades in units of R, so the units of risk, and the risk unit here is the stop loss distance. And the stop loss distance can now be changed, for example, 1%, 2%, whatever you want. And the Excel sheet is built in a way that it even looks for gaps. So if trades are closed by gaps, then we have results which are even smaller than -1, so have, let's say, not mathematically correct, higher numbers. So maybe then you have results of a trade of a -2, -3. If there's a huge gap, this is possible, like in the real trading world, and this is incorporated in the Excel sheet as well. What is incorporated as well is the spread, and there's just an assumption here that the spread is 0.6 for S&P 500. You may find brokers with lower numbers, then you can simply change it. So all the trades are calculated and are calculated appropriate, and by the way, with the same kind of rule that later when I talk about take profits within that strategy as well, there's still the same rule I mentioned in the beginning, stop loss first. So I always look for a stop loss first. In principle, this Excel sheet is already prepared to have a take profit within that strategy as well. Remember how normally within the strategy a trade ends. And the definition was, if the deviation goes back to 0, so it would cross the 0 line, this is exactly the normal signal for a trend should end and should be closed. And therefore, this is in the Excel sheet incorporated as well. This is a trade cross condition. So if the deviation goes back to 0, then the trade will be closed. So in principle, here within the Excel sheet, we have three possibilities to close a trade. One is we have reached the stop loss. One is we can reach a take profit, and I will talk about that later. And one is that the normal condition is fulfilled, namely that the excess deviation went back to zero and crosses zero, and that is a normal definition of a close of a trade. So and now everything is done, and everything is done in R's, so in units of risk. And what we see here, we see our equity line. So not that bad. And we can change, for example, EMA values here and look what happens with the strategy. I can go for example, for higher values of EMA, and you see that the equity line becomes a little bit better here. Let me increase it once again. Changes, yes. Huge changes, no. And now we have the possibility to go here even for different values of stop loss. And the different values of stop loss, let me have it here a little bit smaller because then I have everything on one screen. I can, for example, go here for smaller stop loss values and look for the changes within my equity line. And by the way, it's not that bad to go here for quite small numbers. Anyhow, so but I still prefer numbers like, for example, 1% value for stop loss. In principle, we can go for another trade ending condition, and that is to reach a take profit. Right now, the take profit is put that far away that it will never be reached. And so every trade is closed here by that crossing condition that our deviation crosses the zero line once again, the deviation of the actual price minus the EMA on the price. So that is still the condition which closes the trades here. But if I, for example, go for lower numbers of take profit values, and I go here for take profit values by changing the CRV, or in English it is the risk reward ratio, and then I can get different behavior of my equity line once again. And when I go for lower numbers here, finally it will not be that good. So let's first still stick here to huge values. That means the trade will be closed by the normal condition of the mean reversion strategy, meaning that the overacting distance or the overacting behavior of our underlying goes back to normal once again. I will share with you one observation I made here, and let me go back to what we have done last week. Last week we have had the same kind of strategy, but a little bit different. So last week we did it with the pseudo pair trading with the constant ones in the second part of our pair, and we have had EMA values of 12 multiplier 1, and of course no stop loss. And now try to get the kind of the equity line in your mind, and try to remember when I go here and go for the same conditions like EMA 12 multiplier 1, and now I change my stop loss to a huge number, what more or less means the stop loss will never be reached. I know now in terms of the strategy is not very profitable anymore, but or not that profitable. Right now, for me, it's only to compare the lines. And comparing the lines means looking here, it looks not the same like this one here. Let me put them a little bit more close together. You can, if I switch between the last week's calculation and today week calculation, you see a lot of similarities in terms of the detailed behavior, but it's not really the same. In principle, this one looks a little bit better. And now back to, I did one thing differently here. And the one thing I did different in the new concept was that I calculated the distance between the actual price and the EMA. I calculated that in percent and not in absolute numbers. Let me change that because it's that easy that I can do it here without I have to go here to the first one. And now let's change this back to absolute values. And you can see immediately, now the equity lines looks much more like the one of last week, or to be exact, they look exactly the same. So one thing here, or one observation, to do it on a percentage base to calculate the distance between actual price and the EMA is maybe not the best. I'm still a little bit puzzled about that kind of behavior because that is not my expectation that this has that impact. But anyhow, it looks like that it is better to have this here be done in absolute values. And so now I have them in absolute values, and maybe for whatever reason this is a better idea. Since I want to change this strategy for forex pairs later, I want to change or I want to try this same strategy for other underlyings. I will keep that in mind, and maybe when I go here for DAX values, maybe I go back to a percentage deviation. So I'm not sure. I still have it in mind, so I can try around with that as well. So let me take out here the percentage marker so that we have here normal values. And okay, then now back, this is our equity line. And now we can go for real values of a stop loss and have a profitable strategy back and up and running, and we can try around here a little bit different parameters. And by the way, there's one single number here which is the most interesting number to look for. I don't want to go into those details now. Simply that is one single number which describes the profitability of the strategy, and this number has to be as small as possible. So whenever I change some parameters here, I always look to that number, whether that one goes up or down. And if that goes down, I would like those numbers a little bit more, and I call the strategy a little bit more profitable. So back to those values. We are now able to change values. We can we now have 3 degrees of freedom. We have one is the stop loss distance of a trade, one is our multiplier, and one is the EMA. So those are the three degrees of freedom. In principle, there's a fourth one, and that is a take profit value. Having risk reward ratios of 1000 more or less means that take profits are switched off, so trades are never being ended by take profit, always by the crossing condition. And there's one that's not a real degree of freedom, but if you change the underlying, if you go, for example, for euro, US dollar, or DAX values, you have to change the spread value as well, because it should represent the actual trading conditions. Good. So now, what is the task? The task is now to find good parameters, look for stability, look for whether it's robust or not, try to figure out whether it's a good idea to have a take profit value like here now. Is it a good idea or is it a bad idea? Here now it's not that bad. It's getting a little bit better. Now it's a little bit worse once again. So we can play around with the numbers. We can play around with underlyings. Still we know, hey, by the way, we have an good strategy here. It's already on the screen. The results we have here on the screen are not that bad. I would like to have it a little bit more like a straight line, and here we have also disadvantage right now or up to now is that there are time periods where that kind of strategy does not earn money, it does not burn or it does not lose that much amount of money, but we have phases of 1 year or even longer not earning anything. So maybe we can find parameters which get a little bit better results than shown here. But anyhow, it's a good idea to have that here because we are already on the way to set up the next strategy. We have already the Brent WTI strategy, and now this looks like a new concept for much more strategies because it's easier now to change underlying simply by exchanging the prices here, and then we can figure out additional underlyings as well. So the concept works at least up to now only for S&P 500, and I have not checked for other underlyings until now. Of course I will do, and let's see what might be the results there, because finally I want to have a bundle of this kind of concept for different underlyings and then trading all those different underlyings within one account, but always the same kind of strategy. So there's still a lot of work in front of us. So we are not done. And let's see whether this has some surprises if we change underlyings. And you might already, since you know me a little bit better, that if I say there might be some surprises, that there are some surprises, and I know already a little bit out of for those surprises we will encounter when we do the analysis with other underlyings, but not only surprises, but even new concepts, and you will see. Okay, anyhow, that's for now. We have the next part of the quite good strategy, mean reversion S&P 500. We have Brent WTI. And let's see what we can get as well. Let's go back to my slides. So yeah, we are nearly over. 1 hour is already, and hopefully I can see you back next week. Next week will be, by the way, the last one in this year, because between Christmas and Happy New Year, there will be no webinar, but I will talk about that next week. So if you have any questions, as always, just do not hesitate and send me an email to friedrichowski@argosfx.com. It's always welcome, and I try to give you my kind of feedback to your questions, help you as I can. And yeah, Argus FX, you know, that is the broker of choice for us here. And if you have any questions there, you can contact me as well, or you simply visit the website of Argus FX. But you can ask me if there are any questions. No, do not hesitate. Okay, that's for now. Have a good day, have a good week, and hopefully see you next week on Thursday once again. Bye-bye.